Where do fund managers find growth in a world where investors are emerging market risk averse and developed economies keep pumping quantitative easing? This is the MoneyMakers. I'm Bruce Whitfield. Tonight, we try and get into the head of one of the global investors. Where the global economy is slowing down, you've got Mario Draghi printing money and cutting interest rates to zero. You've got the potential of Donald Trump as the next president of the United States. Where does John Stopford, the co-head of multi-assets at Investec Asset Management, put money? Where do you put money in an uncertain world?
Well, uncertainty is actually often quite a good thing because it creates opportunity. Mm-hmm. It means that things often are cheaper than perhaps they should be, particularly if the uncertainty is overdone. If fear is driving markets, but it's not as justified as perhaps it could be, then there are opportunities to pick up things at reasonably attractive levels and benefit from their recovery.
Now, but those of us with recent memories remember the real fear, 2008, 2009. Yes. There was absolutely no sense of a turnaround coming anytime soon, and yet it hit rock bottom in 2009, and global markets ever since then, probably the longest bear market in living memory, bull market, I beg your pardon, in living memory, 7 years and counting. Markets are still pretty robust.
Yes, we would argue that we've been climbing a wall of worry. We've been fighting fear for most of the period since markets bottomed in 2009.
But isn't that the perpetual state of markets? Isn't that what markets are always uncertain?
They are always uncertain, but sometimes people believe the hype and they get carried away. And one way you could measure this, there are various sentiment surveys measuring how people feel about markets, whether they're bullish or bearish. And there's a very long-standing one in the US looking at stock markets, and it counts the percentage of people who are bullish versus the percentage of people who are bearish. And prior to 2008, that was quite regularly, fairly consistently bullish. Everyone believed that the US was going to continue to expand forever. Stocks would go up. Dow 20,000 or 100,000 or whatever the books were back then. Since 2008, that sentiment has tended to oscillate between moderately bullish and moderately bearish, and occasionally very bearish. And most recently, we've been about as bearish in terms of sentiment as we were post the GFC in 2008, early 2009.
You're talking, of course, of January this year, where suddenly the world was waking up to the fact that there was this great big disconnect between what was happening in real economies and markets, and there'd been this huge jaw developing between markets on the upside and economies which are lingering at best.
Yeah, so I think economies have been unexciting and have had plenty of areas of weakness and structural issues that need to be addressed. But we've sort of been bumbling along in a sort of a slow growth world, which is enough at least for some businesses and some areas of the world to make money. I think the market got caught up perhaps in the signalling that comes, for example, from commodity prices. A lot of the data we receive and a lot of the sort of market price action is linked to manufacturing and commodities, and that's just one part of the global economy. And obviously the size of the falls in some of the commodity indices as well were sort of fairly jaw-dropping. So I think people extrapolated and they read into that, demand is collapsing, recession is imminent. Manufacturing also has been going through something of a sort of an inventory cycle. But actually, if you look at the consumer, you look at services, particularly in developed markets, they've been holding up pretty well. And it's not surprising when you've had US gasoline prices falling from $4 a litre to $1.75. US consumers have got a bit more money to spend on other things.
But we were just talking about this the other day on the show, how the US middle class is being eroded very significantly, how real wages aren't really rising in the United States, and why there is a political turn towards alternatives, and one of those alternatives being potentially Donald Trump, and what the consequences of that might be for an uncertain world. If we think we've had uncertainty in the last 5 years, are we headed to a period of greater uncertainty?
I think we are likely to stay in an era of uncertainty, and you could argue that we're at the end of sort of multi-year cycles of sort of prosperity and wealth convergence going to wealth divergence and capital benefiting at the expense of labour. Lots of trends have been in place for a while, and I think we're sort of feeling the effects of that, and the populism in politics, not least in the form of Donald Trump, is a symptom of that, and it probably hasn't reached its sort of its zenith. No. But you need to look at what's going on underneath. and how things are priced. And I think, yes, there's uncertainty, and Donald Trump probably wouldn't be great news for the US stock market. It wouldn't be great news for global trade. It's probably still an outside risk, although it's getting shorter odds. And yes, but despite that, we would argue that the pessimism that's sort of ingrained in markets, some of that's already in the price.
But is there not a dislocation between market prices and the real world? Because
Yes.
the longer we see this bull market trend continuing, the bigger the fall, potentially.
My disconnect would be the other way around.
Okay.
So my disconnect would be, if you look at the relative performance of global equities versus global bonds, and you look at leading indicators of the global economy, they tend to move broadly in sync. In periods where growth is likely to slow over the next 6 to 12 months, equities start to underperform bonds and vice versa. In the most recent period, we've had equities beginning to price in the prospect of a global recession, and pretty much most of the real data saying the probability of a recession within the next 12 months is still very low. And this is in the context of developed markets, so not necessarily looking at specific emerging markets. And so that divergence actually suggests you should be buying equities and selling bonds, because if the real economy is correct and we don't go into recession, markets have fallen too far and they've priced in too much downside. In terms of your sort of other suggestion that markets have dislocated from reality, yes and no. I think we have to get used to a world where interest rates are likely to be low for a very long period of time within developed markets. We're still seeing rate cuts in Europe and Japan, and in plenty of other. We had a New Zealand rate cut a few weeks ago. Plenty of other economies. Korea is expected to cut rates, and so on. So easy monetary policy is, for the moment, central banks think they can do it all. They can't.
Something that made my blood run cold the other day. I was reading Bill Bryson's fantastic 1927. I don't know if you've read it, but he talks of a meeting that happened in the United States in that fateful year of 1927 when Charles Lindbergh was flying over the Atlantic and all of that stuff was happening. There was a meeting of the world's 3 most powerful central bankers, and they agreed. It was, I think, the German central banker, the head of the Bank of England,
Bank of England was
and the Bank of England, of course, back then, absolutely, and then the head of the US Fed at the time, and they agreed to cut interest rates and to keep interest rates low. That perpetuated the cycle of borrowing and growth, and is held up by Bryson anyway. He's a clever guy. He's not an economist. He's a clever guy, though. He maintains that was a pivotal point for the Great Depression which followed.
I think endless cheap money and trying to sort of outdo yourself in every cycle with ever cheaper money, it hasn't solved any problems so far, and arguably it's part of the reason why we had the global financial crisis and why we had a housing bubble in the US before that, and so on. So central banks haven't particularly learnt. They think they can solve every problem with ever easier monetary policy, but until they change tack, or something forces them to change tack, it doesn't appear that they necessarily are learning many lessons. So, you talk to Kuroda at the Bank of Japan, you talk to Draghi at the ECB, talk to Mark Carney at the Bank of England. They think they're doing the right thing. They are trying to avoid a hard landing. They're trying to avoid a slowdown. They're trying to create inflation. So far, with not a huge amount of success, at least in terms of inflation. And they sound as though they're going to keep at it until they do. So until something else happens.
Does their luck run out before a crash, or does a crash happen and then their luck runs out? Because there is a growing body, Soros and the usual suspects, calling for calamity.
Okay, so I think typically, I would normally take a sort of cyclical view of the world. There are secular forces at work as well. But typically the time you want to avoid owning growth assets, stock markets, is when you go into a recession. And typically the economic cycles don't end of old age. They die because there's a catalyst that causes them to end. And they typically die because they overheat. So you end up creating some inflation, and that's one thing that could happen. And the closest that looks likely to happen there, we are seeing some nascent signs, I think, of inflation in the US. For the moment, the Fed are happy to not really focus on that, but they may have to at some point. So that could be a catalyst. The other big catalyst usually is a commodity price in the opposite direction, i.e. oil prices doubling or tripling, and that could happen. The biggest solution, or the best solution for low oil prices or low commodity prices is low commodity prices, because it kills future investment in supply. So, I don't think we would rule out 2 years from now oil prices being up 100, even potentially 200% from where they are now, if enough future investment has been curtailed.
What does it mean then for people watching this program sitting in South Africa, anywhere else on the African continent for that matter this evening? What do they do? Two-year, 12-month view, 2-year view?
Yeah, looking forward 12 months, 24 months, we think you are well compensated to own equity markets generally around the world. We would argue that at worst markets are fairly valued, major markets, emerging markets arguably are cheap. On a relative basis, given cash in developed markets is close to zero, government bonds are negative in real terms, actually you're earning an unusually large equity risk premium. Other assets like property are probably also fairly valued. We can see some rental growth. As long as you don't expect the recession to happen in the next 6 months or maybe 12 months, and we don't, we think there's very little evidence that that will happen. We also think the commodity price shock can extend this cycle because it is a sort of wealth transfer to consumers. As long as the recession is delayed or is pushed out further and the cycle continues, we would rather be in growth assets than defensive assets, particularly on current valuations. So, there are other opportunities being created. Worries about defaults in the US energy market mean that high yield corporate bonds are starting to look interesting again, having looked expensive and so on. So it's the fear we think that actually makes these markets interesting. The fear is too soon and it's maybe misplaced. And so there are plenty of opportunities still. We're late in the day, it's late cycle. We're in the last third of this bull market, probably, maybe even less than that. But you might as well play it while it lasts and try and get out before it ends.
What about South African investors sitting with messy politics and a finance minister who is desperately trying to take business and unions along with him on a drive to avoid a ratings downgrade? What about this environment?
Well, I'm sure that also creates opportunities within your own country, but clearly one of the things investors can do is diversify some of their assets offshore. So look at more defensive alternatives or different investments that exist elsewhere. And a lot of South Africans are doing that. So I would argue that most people are reasonably well placed. Short-term view on the rand is incredibly difficult. The rand is hugely volatile. We tend to think that commodity prices are close to forming a base because we think supply destruction is now happening. The rand has a linkage to that, but it's also buffeted by the political factors, ratings, the current account, etc. So, where's the rand going to trade? I don't know, 17 to the dollar down to 14 to the dollar and probably there and back again. We're not especially bearish at these levels, but things could go wrong.
Bullish or bearish, as it turns out.
Yeah, well, no, exactly. So there are plenty of other things we can play offshore that don't involve us taking a view on whether the rand is going to go up or down in the short term. In the longer term, having a diversified portfolio, having some sort of safe haven exposure is probably a prudent thing to do.
John Stopford, thank you very much. John Stopford is the co-head of multi-assets at Investec Asset Management. Always interesting to talk to him and pick his brain on the world around us, even if sometimes it's a little bit scary. More big stories, more money makers next time. Thank you for watching. Good night.